Silicon Valley Bank, or SVB, was like the cool, hip bank for all the tech startups. It was their go-to place for loans and keeping their cash. So when it suddenly collapsed, it was a huge shock, especially for the tech world. It's like the only pizza place in town suddenly closed. That's kind of what happened to the startups that relied on SVB. SVB wasn't just any bank. It was a big player in the tech ecosystem. Its collapse left a big hole, and everyone was worried about what would happen next. But let's look at what caused this mayhem. First, like this video and subscribe to our channel. A few things went wrong at SVB, all at the same time. It's like a perfect storm of bad decisions and unfortunate circumstances. First, there was a classic bank run. People panicked and rushed to take their money out, fearing the bank might collapse. And guess what? That fear became a self-fulfilling prophecy. Second, SVB made some risky bets with its investments. They put a lot of money into long-term bonds, which lost value when interest rates went up. It's like buying a bunch of ice cream on a hot day, only to find out the price of ice cream just doubled. Ouch. Third, the Federal Reserve started raising interest rates to fight inflation. This made borrowing money more expensive and squeezed SVB even harder, adding insult to injury. Finally, SVB's heavy reliance on the tech sector made it extra vulnerable. When the tech industry started to struggle, so did SVB. It's like putting all your eggs in one basket and then dropping the basket. SVB's collapse wasn't an isolated incident. It triggered a domino effect, taking down other banks with it. Signature Bank and First Republic Bank soon followed suit. It was like a game of Jenga where one wrong move brings the whole tower crashing down. The government had to step in with massive bailouts to prevent a full-blown financial crisis. They essentially printed a bunch of money to cover the losses and protect depositors. This raised eyebrows and sparked debates about whether these bailouts were the right move. Some argued it was necessary to save the financial system, while others worried it would encourage risky behavior in the future, each being right in their own accord. But what actually went wrong? After the dust settled, everyone started pointing fingers at the regulators. They were supposed to be watching the banks and making sure they weren't taking excessive risks. So how did they miss the giant red flags waving at SVB? Critics argued that regulators were too lax and allowed banks to get away with too much. Others claimed the regulations themselves were flawed and needed an overhaul. It was a messy blame game, with no clear winners. Regulators proposed a bunch of new rules to tighten things up, but the banking industry wasn't thrilled. They argued that the new rules would stifle lending and hurt the economy. It's a delicate balancing act between protecting the financial system and allowing banks to do their thing. The collapse of SVB hit the venture capital industry and tech startups particularly hard. They relied on SVB for funding and other financial services. It's like their favorite candy store suddenly closed, leaving them with a serious sugar craving. Venture capitalists had to scramble to find new ways to fund their portfolio companies. Startups faced cash crunches and uncertain futures. It was a tough time for the tech world, and many wondered if this was the beginning of a bigger downturn. The crisis highlighted the importance of diversification. Startups learned the hard way that relying on a single bank for all their financial needs is risky business. It's like putting all your money on one horse in a race. If that horse loses, you lose everything. How to avoid future bank runs. The SVB saga taught us some valuable lessons. First, risk management is crucial. Banks need to be careful about where they invest their money and avoid taking on too much risk. It's like playing poker. You need to know when to hold them and when to fold them. Second, diversification is key. Don't put all your eggs in one basket, whether it's your investments, your customers, or your funding sources. Spread the risk around and you'll be more resilient to shocks. Third, regulators need to be more vigilant. They need to keep a closer eye on banks and be ready to intervene when things start to go south. It's like being a lifeguard. You can't just sit there and watch people drown. The long-term impacts of the SVB collapse are still unfolding. It raised concerns about the stability of the financial system and the potential for future crises. It's like a small earthquake that makes you wonder if a bigger one is coming. The crisis highlighted the interconnectedness of the global financial system. What happens in one country can quickly spread to others. It's like a butterfly flapping its wings in Brazil and causing a hurricane in Florida. The SVB collapse was a wake-up call. It reminded us that even seemingly strong banks can fail, and that the financial system is more fragile than we might think. It's a reminder to be prepared for anything, because in the world of finance, things can change very quickly.